Hey, hi everyone. Welcome to another strategy in our positional option selling strategy adjustments. Okay, so today we are going to go through covered call and covered put positional trade in Indian index markets and the adjustments that could be done for these two strategies, covered call and covered put positional trade. We will go through some examples of Nifty, Sensex, and Bank Nifty for each adjustment that could be done. So covered call, what is it? So covered call is you'll buy a long, you'll go long on the futures, or you'll buy a stock, or you'll go long on the stock, and to protect yourself, you'll short a call. Okay, so the position is buy either Nifty, Bank Nifty, or Sensex futures or stock, and sell an OTM call. So it's a combination of futures or stock plus options strategy, where if your view is bullish, that's when you mildly bullish to sideways, then you go for this covered call strategy, and you buy a Nifty future or a stock, and you sell an OTM call of the Nifty. Okay, and your view is mildly bullish to sideways, and income from call premium will cushion your downside. Okay, risk is there, unlimited downside risk is there since we have longed the futures, and upside is capped at the short call strike. So different adjustments that could be done for a covered call. So the first thing scenario is if market rises sharply beyond your short call strike, then your the market went in your direction. So you have you had a covered call position, which is a mildly bullish to sideways position. So your profit is capped here, and short call will go into ITM. So adjustments that you could do is, if you feel like the market is still going to be bullish, you roll up the short call. Suppose you buy back the existing shorted call, and you sell a higher C to extend your profit zone. Or you could just convert this entire covered call into a bull call spread. Close this short call and buy a higher C to participate in the rally. Or you can also do convert into a collar, like add a protective put, limit downside if trend reverses. So example, if market rises sharply, is suppose Nifty is at spot 20,000, you have taken a long futures of 20,000 and shorted 20,200 CE. Okay, if Nifty went to 20,600, you'll roll this short 2,200. You'll close this, and you'll short 2,600. That's what you will do. Okay, so the next scenario is the market falls. So here there will be loss. So futures will loss will be there in the futures because we have long the futures. But C premium we will receive, but futures loss will be greater than the C premium we will receive. So to adjustments that we can do here is we can sell more calls, okay, OTM and ATM calls, to convert into a ratio call, right, okay, or you could convert it into a protective caller by OTM put for hedge. You can just put buy a OTM put for hedge, or you could exit these futures and keep the call short, turn it into a naked short position. Okay, so that's what you could do if market has fallen. Um, so example is Nifty is at 20,000 and it fell to 19,500. You can short CE 2,200, still OTM, add another short 19,800 C to collect more premium, or buy 19,500 P for protection. Okay, if market stays sideways, then time decay will help you, but low moment will be there. So the time decay will come from the C thing. So that will give you money. Futures will stay neutral, but the options will give you time decay, and limited income will be there. Okay, so if you want to do adjustments here, you can roll down the call to collect more premium. You can sell an additional OTM call to increase the theta decay and income, or you could convert into a short straddle or the triangle to collect the both C and P premium. Okay, so that is the covered call adjustments. What happens if market rises sharply beyond call strike, if it falls, as well as if it stays sideways. The covered put is exactly opposite of it. So in a covered put, what you will do is you will short a futures and you will sell an OTM put. View here is mildly bearish to sideways. Income from put premium cushions upside loss. Okay, but risk is there. Unlimited upside risk is there since we have shorted the futures. But downside is capped at short put strike. So again, same here. If market falls sharply, this is in your favor. Profit is capped. Short put will become ITM. You can roll down the short put further, or you could convert into a bear put spread, or you could exit short futures and just keep the short put. Okay. Similarly, if market rises, this is against you. So futures will lose heavily. Short put will become worthless. So here you can sell additional calls to protect to turn it into a short strangle, okay, or you could convert into a protective collar by buying an OTM call to cap upside loss, or you can exit the futures and just keep the short put, okay, which will protect you from the which will give you profits if market falls, if market rises, okay, because you're shorted a put here, if market rises you will make money, okay. Yeah, here what we are doing is we're selling a put and we're shorting the futures. So the short put, if you just keep it, if market is rising, then you will make money, okay. You can buy an OTM call also to capture the upside moment. If market is sideways, you will gain money. Future loss may get offsetted by put decay, or you may have a limited profit. So you can roll down put closer to collect more premium, or sell both C and P, convert it into a triangle for extra theta income, or you can square off the futures and just put a short put. Okay, so that will give you directional bullish risk will be there, but it will get you more theta decay. Okay, expiry week adjustments. Gamma risk is high, so sharp intraday movements will be there during expiry week. So manage ITM positions early to avoid assignment. Convert covered call into a collar. Add a PE for protection, and covered put into a collar. Add CE for protection. Summary. Okay, so adjustments are: if covered call market is up, you roll up the CE, profit is capped here, okay, roll up the C and convert into bull call spread and exit the P. Market is down, sell more C, add protective P. Sideways, roll C closer and add P short. Covered put, sell C, okay, for strangle. If market is up, buy C for hedge. Okay, covered put, market is down, roll down the P and bear put spread, you can convert it. Sideways, roll PE closer to collect more premium or sell another, sell C. So that's adjustments. Key takeaways are: covered call is bullish to neutral strategy. Adjustments mostly roll up the C or add protection. Covered put is bearish to neutral strategy. Adjustments are mostly roll down PE or hedge with the C. So that's the covered call and put strategy, guys, and the adjustments that could be done in a positional trade for covered call and put. Thanks everyone. Have a nice day. Bye.